Hi, Clint Coons here with Anderson Business Advisors, and in this segment I want to discuss buying property in a limited liability company and the various ways you can do it based upon how you're going to pay for the property. Now, when you're buying long-term, there's typically 4 ways we're going to buy property. That is, either you're going to buy for cash, you're going to use traditional financing with a lender, you're going to get a standard loan, you may use private money, or you could be using institutional financing. Let's assume that you're buying a pool of properties. Now, depending on the type of financing that you're going to use to acquire these properties or the cash that's being used for them, that is going to change how we recommend you structure that deal. Now, this is very important when you're buying real estate with a limited liability company, because you don't want to end up at 2 days away from closing and all of a sudden the underwriter tells you, hey, we can't close the way you're looking to do it because the LLC is wrong, or we can't even take title in the name of the LLC. So what you want to do is make sure you're setting it up right at the outset so you can close on time. And point of fact, what I tell people all the time is check with title, check with the escrow right when you start the sale, entering into that agreement or purchase and sale agreement, to find out what they're going to need at closing, to find out if you can even close in a limited liability company. All right, with that being said, let me just show you how you should structure these deals based upon the financing you're using. So let's say I'm buying for cash. So this is cash. If I'm going to buy this house for cash and I want to create a limited liability company, I will do that typically in the state where the property is located. So I'll set up my LLC. Ideally, you want to get a bank account opened ahead of time, but this isn't necessary. You can always, if you don't get the bank account set up in the LLC ahead of time and you have the cash in your own name, you can pay the cash to the seller over here and then just have escrow or title, put title into the name of the LLC at closing. That's one way to do it. Or you can contribute the cash to the LLC and then have the LLC pay the seller, and then the property will flow into the LLC at closing. So cash is probably the simplest, most straightforward process when it comes to closing. But here's something you may not know that you will need. You will need at closing to get a certificate, a cert of good standing. All right? You're always going to need a certificate of good standing when you're closing in a business entity. You obtain this from the Secretary of State where the entity is filed. Now, the reason I'm bringing this to your attention is that depending on the state, this can sometimes take up to a week to acquire. You don't want to be in a situation, like I said, where 2 days before closing, you're told by title you need this certificate or they will not allow you to close in your LLC, and now you have to push your closing back, a week or 10 days. So make sure you line this up ahead of time. Now, these certs, they're only good for 30 days. So you can't get it 7 months in advance because that will not work either. It's considered to be stale at that point in time. All right, so that's cash. Now, let's assume we're dealing with traditional financing. I'm going to be working with a Wells Fargo, and I have a limited liability company here. Here's the seller over here, here's the property, and here I am down here. Now, this is traditional financing. All right, so what do you do in traditional financing? In that case, you're going to buy in your own name. Unless you're dealing with a lender that is a community bank and they intend to treat it as a portfolio loan, it's just not going to happen, because Fannie Mae, Freddie Mac's going to require, if it's residential real estate, that the bank write a residential mortgage, and that doesn't allow you to close in a limited liability company because that would be a commercial loan. So what you're going to have to do is close in your own name, pay the seller, so you'll put your down payment, will go to the seller, the bank will finance the difference, and then you'll take the property, you'll take title back in your own name. Now, your LLC is sitting up over here on the side just waiting for you now to move your property from your name into the LLC for asset protection. So after you've closed, title is now in your name, that is when you can deed the property into the LLC. Now, if you're not using us, just make sure whoever you use to deed this property into that limited liability company uses a warranty deed. Do not use a quit claim deed or you're going to void your title insurance policy. Okay, hear that again. Do not use a quit claim deed or you will void your title insurance policy. So that's buying with traditional financing, just like this. Now, what will change if I'm using a private money lender? Private money, okay, or community bank. community lender. Okay, these are pretty much, they're both going to be the same here. So again, we're back to our structure. Here's the seller, here's the property, here's my limited liability company, here's me down here, and I want to buy that. Well, in either case, you're going to be able to close in the LLC. So it's similar to buying for cash when you're dealing with a private money lender or a community lender. You're going to use the LLC to take title to the property. Again, you can get the bank account set up in the LLC and pay for the funds out of there, or you can pay, lender's going to come in to finance the property, take back a first deed of trust, and then closing will handle inside of the limited liability company. It's pretty straightforward on that one as well. And again, you're going to need that certificate of good standing because you're closing in the limited liability company. All right, the last one I want to cover is institutional financing. Now you've moved up a notch, and now we're ready to take down bigger deals. I mean, we're doing 10 properties, 20 properties at once. Now you have access to Wall Street money. How does that change the scenario? Well, it changes it based upon the limited liability company. You see, those LLCs that I was showing you are typically going to be filed in the state where the property is located, where you're buying. But when we move into the institutional realm, they're not comfortable with that. So when you're using institutional financing, the steps work as follows. You will be able to close in that limited liability company. And where the money comes from, it doesn't matter for institutional financing. It either comes from the LLC or it comes from you personally. So here's the seller now in this scenario, and typically in this scenario, you're buying a pool of properties. All right, 10 or more is what you're doing, like that. So I'm going to buy this pool of properties. You're going to need at least 25% down to put these types of deals together. But I'm going to close in this LLC. Now, in order to close in this LLC, what they're oftentimes going to require is that you set up a Delaware LLC. I've done this multiple times, and every time, it's always the same. You need to set up a Delaware LLC, and then you foreign file it in the state where the property is located. So recently I did this with Texas. In Houston, I bought a pool of properties, and so what I did is I set up my Delaware LLC, and then I foreign filed it in Texas, the LLC doing business in Texas, in order to close on those properties. So it's a Delaware LLC, foreign filed in Texas. And again, you still need the certificate of good standing in order to accomplish this. A lot of times when I have to do this, when I put together this type of structure, since it's Delaware, I'll also create this little holding LLC down here, a Delaware holding LLC, that will own this interest. And again, this one will also have to be filed in Texas as well as a foreign LLC that gets registered there in my example. That's helping to provide, again, that anonymity layer, and it's giving me additional level of asset protection when I stack them on top of each other like this. In some of my other videos, my examples, I often use Wyoming, and in this case, since we're using institutional financing, Wyoming will not work. So if you're going to go down that road, then count on using Delaware. My name is Clint Coons with Anderson Business Advisors.